Good morning. My name is Andrew Maramag, CEO of Sneakers Delivery Incorporated. Today, we will discuss what Sneakers Incorporated is all about, the importance of financial statements, and our roles in making this company profitable and successful. We'll also talk about the different types of financial statements and the different ratios we utilize to build these financial reports. Just a quick overview of our company. Our company, Sneakers Delivery Incorporated, was founded in 2006 by a sneaker enthusiast and collector. Although there are already a platform for sneaker selling and delivery like eBay, during that time, the authenticity guarantee is not reputable, and people are losing a lot of money. The company, a US-based organization, authenticates high-value sneakers and works with reputable delivery agents like USPS, FedEx, and DHL to ensure timely delivery with guaranteed insurance. Currently, we are comprised of 12 employees with 150 authenticating partners worldwide, so it lessens the amount of transit time from manufacturers or sellers to authenticator and finally to the buyer. We boast a 100% on-time delivery rate or earlier than what is expected. But like any other company, a report is needed to analyze an organization's health and operability to gauge what must continue to function well. For companies that operate within the market, financial statements are required to ensure that the organization is legally conveying its future investments and current business activities. Furthermore, financial statements are reports that provide the detail of an entity's financial information, including assets, liabilities, equities, incomes, and expenses. Additionally, shareholders' contribution, cash flow, and other related information during a reporting period. Financial statements are annual reports prepared by the management at the end of an accounting period in accordance with the generally accepted accounting principles and concepts. It is a collection of accounting information that helps the management communicate its financial information to its various users, and also they are the end products of the firm's financial affairs expressed in monetary terms. So what is it for us? For us owners, financial statements provide information regarding the business financial condition in which they invested our funds. This also helps the owners to assess whether their funds are properly utilized or not. For you employees, statements will give overall profitability and solvency of the business to the employees, which in turn help you all in matters of incentives based on our profits. The management. It helps the leadership in decision-making processes. It also enables the management to exercise control over those activities which are deviated from the budget. And our creditors. Creditors are interested to know about the short-term and long-term liquidity of our business. The financial statement reveals an accurate and fair view of profitability and financial position of any concern regarding the business. The investors. Investors analyze the final financial position and operating efficiency of the business in which they made investments. The investors are also interested in those companies which have a good prospect in the future. Government. Financial statements are helpful to the government at the time for tax computation and also to ensure that all legal provisions are complied with. Bankers. Bankers and other financial institutions look into the financial strength and profitability of the business. They are also interested to know that whether the company is able to repay the principal amount with interest or not. And finally, the public. Since business is a social entity, it has to have the responsibility to fulfill its social obligations. Showing it to the public allows interest in evaluating the financial statements so that they can judge whether that concern meets its social commitment or not. Next, we have the different types of financial statements. The main types of financial statements are the income statements, balance sheet, and the cash flow. And we're also going to talk about the financial ratio that assists in making these reports. The classification of financial statements, another classification of financial statement is the balance sheet. The balance sheet represents the organization's stockholders' equity as well as the assets and liabilities during a specific period of time. Additionally, the balance provides a quick snapshot of what a company currently owns and owes, as well as the amount invested by the stakeholders. Finally, the balance sheet also provides a basis for computing and evaluating its capital in structure and the rate of investment and its operating return. Next up is the income statement. The income statement is best described as a report that shows the profit that an organization makes after its deduction, taxes, and interest lost from its operations or expenses associated with earning the profit. Preparing and analyzing the income statement assists decision makers in identifying trends in the business's profits and expenditures during its operations over the period of time. Moreover, the information can improve business decisions to assist the company to be more efficient and profitable. Finally, the cash flow statement. The cash flow statement exhibits the amount of money that a company uses for its operations and expenses. Additionally, the report summarizes investments and financing, then it reconciles them with changes in its marketable securities and cash on hand during the period. This report is also required because it advises the company's stakeholders and decision makers on the organization's cash position to operate without going under. In order to make all the financial statements, there are several things that we have to use, such as financial ratios. Financial ratios, also known as ratio analysis, is the quantitative method of gaining insight into the company's liquidity, operational efficiency, and profitability by studying its financial statements, such as the balance sheet and the income statement. There are several types of financial ratio. There is the liquidity ratio, the activity ratios, the market ratios, and the debt ratios. And finally, the profitability ratios. So first, we're going to talk about the liquidity ratios. There's two types of liquidity ratios. It is going to be the current ratio and the acid test ratio. Liquidity ratios is the ability of a business to meet its short-term obligations when they are due. The current ratio is the capability of an organization to repay its current obligation at any given period of time. The acid test ratio, also as the quick ratio, measures the company's current asset that can offset its present liability. The next type of ratio we're going to talk about is the activity ratio. Activity ratios are used to calculate the ability and the speed of a company to turn its accounts into assets or cash. There are four types of activity ratios. The first is the inventory turnover. The inventory turnover assesses the movement and activity of a company's current assets and inventory. The average collection period assesses the policies in regards to credit and collection. Then we have the average payment period. It is similar to the average collection period, but it measures the standard accounts payable. And finally, the total asset turnover. This measures the ability of an organization to provide profit and sales by using its assets. The next type of ratio is the market ratio. The market ratio is used to evaluate the company's stocks share prices. It gives investors insight regarding the organization's status on financial risk and return. Underneath market ratios are the price-earning ratios, which measures the amount of money that the investors are willing to match with the organization's earnings, and the market book ratio, which provides the appraisal on how investors look at the company's performance. Next one is our debt ratio. Our debt ratio measures the amount of leverage used by a company in terms of a proportion of assets that creditors finance. Underneath debt ratios, there are several ratios that we can utilize. There is the debt to equity ratios, which measures the proportion of stock equity used to finance assets to its current liabilities. Then there's also the time interest earned ratios, which is commonly known as the interest coverage ratio, which measures the company's ability time-bound payment with interest. And finally, the fixed payment coverage ratio, which measures the organization's ability to repay lease or principal payments as well as stock dividends. Finally, the profitability ratios. This will enable business analysts to ensure the company is making enough money to be able to operate and pay for its operation. There are several types of ratio that falls under the profitability ratios. These are the common size income statements, which evaluate the company's profitability in relation with sales and services. The gross profit margin, it measures the proportion of money left after the company has paid the material used for their operation. We also have the operating profit margin. This measures the amount of money remaining after the company after what the company spends aside from its taxes, dividends, and interest paid. Then we have the net profit margin. This is the measurement of the true earning of an organization. Then we'll have the earnings per share. This exhibits the amount earned during a reporting period for each stock share. Then we have the return in total assets. The return in total assets, known as return on investment, measures the profit through the managerial effectiveness on generating a profit return. And then finally, the return on equity. The return on equity measures the return earned on stockholders' investment in the company. Why is it important to use financial ratio? Financial ratio is used to simplify any accounting data that surrounds the company. Ratio analysis presents complex accounting data in a more straightforward and understandable form by expressing the items in percentage. It established the relationship between financial statement items in most simple language. It also helps in analysis and decision making. Ratio analysis helps various stockholders like creditors, employees, owners, banks to obtain information regarding financial performance and position of the company. This allows them to make decisions by the process of analysis and interpretation. Financial ratio can be utilized as a basis for comparison. Ratio analysis helps both for intra-firm comparison and also inter-firm comparison so that they can figure out if the company is working well and performing well. It also provides business standards. Ratio analysis provides ideal standards for measuring efficiency. Additionally, actual ratio can be compared with excellent ratios for evaluating efficiency and effectiveness of the company's operations. It also helps in evaluation of overall performance. Ratio analysis helps in the evaluation of overall performance of the company by analyzing profitability, liquidity, and solvency. Financial ratio also helps the company in forecasting and estimating a trend in the market. Ratio analysis establishes the relationship between two accounting variables which are also always interrelated. This helps in forecasting and preparing plans for the user, the analyst, and the owners. Accounting ratios of several years reveal the trend of financial statements components such as costs, revenue from its operations, and net profit. It also helps in making investment decisions.